Hello and welcome to the Gold, Goats, and Guns Market Report for today, Wednesday, January 25th, 2023. My name is Tom Luongo, and we have a lot to talk about. Quick note. I wrote a thing on Monday talking about the event down in Orlando. It'll be the last time I mention this in any of these reports so as to not make everyone who couldn't be there feel like they were left out or anything. It was really lovely. It was really great. I wish I had a little bit more, wish we had had a little bit more time to spend together as a group. And that would have been great, you know, to maybe do a little bit, you know, more back and forth between all of us, between myself, Dexter, and the assembled group. But, you know, then we hung out, and for those of us who went to the bar and were cold, I know I was, because I stupidly thought that, yeah, a t-shirt in Orlando, 10 o'clock, yeah, how bad could it be? Man, that was the wrong decision. So, but it was fun, and they had a great time and all of that. So we will do it again, and we will do it in a more formal way to, you know, bring the community together. We had a lot of really interesting ideas come out of it. We had a lot of very good suggestions from everyone, and we used it as an opportunity to get feedback from y'all. And, you know, we're listening. So we'll definitely figure something out for later in the year, somewhere else in the world. All right. That being said, this is your first time in Fight Club because of all the new patrons that showed up with yesterday's marketing email. And I only do one of those a month. You have to stay to the end, just because you need to see the whole thing. Then you can choose what you ingest. I don't care, but I'd at least like you to watch at least one full market report all the way to the end, so that you can get the full effect of what's going on. And if you're confused about what's going on and all the rest, that's fine. And you take what value you can out of it. All right, let's move. So let's get started. All right, I want to talk about a couple of things. I was asked to talk directly about this purge at the top of the Ukrainian government. Also want to talk about, you know, this weird thing that's going on with the United States and sending Abrams tanks and, you know, threatening Germany over sending Leopard tanks and all the rest of it. You know, I listen to a lot of stuff, and I haven't had Ukraine really on my radar for a while. And I, you know, admitted this to Alex Mercuris when we were talking about this last week, because I didn't feel that that's where the story was. I felt the peak Davos and the capital markets and, you know, what's going on with the Federal Reserve, as far as I'm concerned, was the story. But I do believe that now Ukraine is becoming a bigger story. So I've been spending a little bit more time trying to get caught up as to what's going on and what I think's happening and all the rest of it. And I just spent about 20 minutes chatting with Dexter about this stuff, and he gave me his roadmap as to where he thinks all this escalation is going, and you know, and I have a very confused feeling about what's going on, and I will say the following. And we chatted about this on Slack a little bit, and for those of you who aren't sure what to do to get on Slack, you send me a DM on Patreon, and I will send you a link, because the link expires. So I really should have been saying this at the beginning of every market report for the last 6 months, and then there wouldn't be any confusion. But it is like everything else. Yeah, I have a mind like a sieve, and there's too much going on in my head. What a shock. All right. So the situation with the situation in Ukraine, you can read it one of two ways. And there's the glass half full version, which is the one I would prefer it to be, which is that Zelensky is trying desperately to stay in power because the ground is shifting underneath him, because support for him actually is beginning to wane, because there's a split at the top of the American plutocracy as to whether or not we're going to go full on towards headlong into World War III or not. That's the glass half full scenario. People resigning, you know, the heads of 4 different oblasts resigned. There's, you know, a big shuffle in Zelensky's cabinet, all this stuff, right? And so when you think of that, when you look at it from that perspective, well, it looks like there's this is a big deal, right? And it could be a good thing, because if we can get Zelensky to the bargaining table, then maybe we can end this thing in some reasonable manner. Then we know that George Soros is going to the Munich Security Conference to give a speech and basically to tell everybody that we need to, make the world safe, to kill Russian Christians and all the rest of it. Because, never underestimate the antipathy of Russian Amish towards Russian Christians. So, these are so many of these dynamics are at play, and trying to figure out who's actually in charge is the big question. So that's the glass half full, that Zelensky is in trouble. This is why Boris Johnson, of all people, had to go to Kiev and, shore everything up. But at the same time, all of this happened just a couple of days after CIA Director Robert Burns showed up in Kiev, and then all of a sudden there was a big purge. And, the neocons seem to be winning the fight on Capitol Hill to get to upgrade U.S. support. Now that we're talking about tanks, Dexter is convinced that everything that's been going on, from a cyber perspective, is the Russians doing, like the FAA thing and the rest of it. Tucker Carlson saying it's the Chinese, I think, is off base. I think it's the more explanatory version would be the Russians did this. And we're now responding in kind with, well, we're going to say, okay, so if you're going to take out our air infrastructure, then we're going to send tanks into Ukraine and we're going to have a war. It doesn't matter at this point. And I honestly, this is, and again, the conversation that Dexter and I literally just had, I had to, kick him off the phone so I could record this morning, is that this isn't a judgment thing. This is just, okay, move, counter move, counter move. And knowing people involved and knowing what we're dealing with. So but the glass half full scenario is, Zelensky's in trouble, and, the neocons are desperately trying to shore up his position as best they can and insulate him from being, regime changed. Because the pressures are that the Russians and the sovereigntist plutocrats, as I'm now starting to call the whole Fed New York boys thing, is pressuring, is starting to pop off. And we're starting to see certain people crack under the pressure of all of this. That's what we're seeing. And we're starting to see it. The surge in the FPO in Austria, which is point number 2 in the polls, over immigration and support and antipathy to Russian sanctions and inflation and all the attendant secondary and tertiary effects of cutting off Russian energy to Austria, they're now leading in the polls. And it's a big deal. And the government could fall, right? Well, again, this is the kind of thing that, these cracks are beginning to show everywhere. Mark Rutte, the prime minister in the Netherlands, one day last week said we should open up negotiations with Russia and end the war. 4 days later, he was, had to reverse himself because somebody visited him, put him in an envelope on his desk and went, this is what you're going to do. So it's clear that everybody is calling in markers left and right to continue this insane push towards World War III. The question is, have they called in all the markers? How many markers do they have in reserve? How many manila folders are going to be passed out, and who's passing them out, and how many are there? And this is the confusion, because the glass half empty situation is, of course, that the neocons are firmly in control. We're going to send U.S. Tanks and U.S. tank crews into Ukraine. And then it becomes a question of, okay, have we seen the Russians' best at this point? Dexter thinks we have. I'm not so sure. And so, that's going to be the real question. That's going to be the real thing. Because, look, if we move tanks in, if we put M1 Abrams and Leopards and everything else into Ukraine, as has been discussed by Brian at New Atlas and the Duran and others, there ain't no way the Ukrainians are going to be able to operate those tanks properly. So if those tanks are operated anywhere close to anything above 50% effectiveness on the battlefield, they will be manned by NATO crews. At which point, now the Russians have to respond. And they're going to respond by declaring war on NATO. And then what? Effectively. And then what? You know, this is the escalatory framework that we've been pushed into. And where does this go? So, you know, the framework for our discussion this morning was that Dexter's completely convinced now that they think they're serious that they can take Crimea. There was a note from London Paul at the Sirius Report this morning on Twitter saying that his sources are saying that Erdogan's going to leave, Turkey's going to leave NATO in 6 months. I said, I don't believe he has any sources whatsoever that's the case. I just think he's reading the tea leaves, and smartly, I might add. I don't disagree with London on geopolitics. I just think he's all wet when it comes to understanding what the role of the Federal Reserve is right now. And there's no point in me talking to him about it because he's completely convinced, and he's basically told me I'm full crap publicly on Twitter without actually adding me, because, you know, that would mean that he would have to actually give me credence. So fine, we'll play that game. We'll play the game of mutual. We'll play that game. It's fine. If he wants to play that game that way, he's more than welcome to. But I think he's correct in reading the tea leaves that Turkey will have to leave NATO in 6 months. I also don't think that that what we're sending into Ukraine now will be ready for any kind of offensive until 2024, or at least in Q3 of this year. So what if the Russians launch a counteroffensive before the Ukrainians are ready? This is what I see. See, Dexter sees all of that stuff, and I see timing. And the timing here is that the Russians are going to go first. And when the Russians finally put their actual Russian army on the ground in Ukraine and not keep using Chechens and Donbass militia and Wagner mercenaries, and they actually put Russian army regulars on the ground, what are we going to see then? And so these are all good questions. I don't have a good answer for any of this. I don't have a handicap at this point, but I think these are all reasonable things to counter. Because if London's right about his read on Turkey, which I think is a good one, it would only be because in 6 months' time, we would have escalated the war to the point where NATO would demand access through the Bosphorus and the Dardanelles from Turkey, and Turkey says no. At that point, Turkey will have to leave NATO. And then at that point, everything changes. Do you understand what I mean? Do you understand the logic there? Is Erdogan would have to defy NATO over allowing U.S. and British NATO ships into the Black Sea, invoking the Treaty of Montreux, or not even, just saying no, flat out. And at that point, you know, he will be asked to leave NATO. At that point, everything changes. And then I want to understand how anybody thinks that we're going to be able to support a full-scale, you know, pushback of pushing the Russians out of Ukraine completely without access to the Black Sea. I want to understand that one, because I think that's hilarious. And I mean that sincerely. I think that's hilarious, because I don't think that's what's going to happen. So amidst all of this, we have a surge coming from. I'm sorry. I was just noting something about the. I hope the sound isn't bad. I will have to check this. Unfortunately, we're getting some like weird stuff happening here and there. I have to remind myself not to raise my voice at all. Yep, there it is. So back that off a little bit. All right, there it is. Doesn't look like I can. Yep, that good. That's good. Okay. So if there was some flaking out, I'm sorry. Up until this point, I'm sorry. Weird stuff going on with the sound system on my. Well, this is about my desktop. This is not about any other physical connection or anything. This is about getting these levels right on a PC whose sound handling is quite poor. All right. So, but at the same time that all this stuff is happening, sorry for that. Everybody just, fast forward through that last minute. We have a situation with the dollar that is it's supposedly quite dangerous. Like everybody is now fully convinced that the dollar is going to be in trouble because all the Saudis and are rejecting the petrodollar and blah 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 blah, and everybody's counting their chickens before they're hatched when it comes to the end of the death of the U.S. dollar. We have a bear market in the dollar, or at least a bear bull market correction in the dollar that's been going on longer than I expected, and everything else. So, what does this mean? Well, I think they're still wrong. The Bank of Canada came out this morning, raised by only 25 basis points. Of course, Zero Hedge was out there going, look, first pivot. I'm like, come on, man. Like, we're at 5% for Christ's sake. Even if the Fed does only go 25 basis points, which we're going to look at the data in a couple minutes. It looks like it may actually be the case, or we're going to have a rate shock in a week. Okay, we're a week away from the Federal Reserve, and are we going to have a rate shock? It's a good question. Right now, LIBOR and SOFR are saying 25 basis points. Everybody's saying 25 basis points, except the Fed. And that's the interesting part about this. Now, even if they only go 25 basis points here, even if they only do that, that does not mean that they are done. Now, you're going to have to listen to 8 weeks after that. You'll have to listen to 8 weeks worth of everybody going, oh, my God, the Fed pivoted and we were right. And like, yeah, you were right. Like, you best stop clock impersonation. You just keep screaming pivot until you're right about it. Like, oh, OK. And then, as always, you go fuck yourself and we'll call it even. Good article this morning right after that, after the Bank of Canada thing on Zero Hedge from Bloomberg, saying with the guy going through M2, and because everybody's now screaming about M2 going negative and all of this stuff. And for once, actually, it was a real good article from Bloomberg and not Davos supporting nonsense, because he went through and he said, look, the Fed last year at the behest of Congress changed the definition of M2 and moved most of savings out of M2, which is part of the reason why M2 has gone negative, because it no longer, the primary component of M2 was reclassified into M1. And when you what he did in this article on Zero Hedge from Bloomberg this morning is he went back and just recreated the classical M2 and, showed you where you are. And M2 is generally countercyclical, meaning because the majority of M2 is savings, high M2 growth does not necessarily, actually shouldn't create price inflation because people are saving, right? The money's not circulating, especially if you're talking about a credit environment where there's not a whole lot of real return out there, which we haven't had for quite a long time, most of a generation now. So especially under those circumstances, high M2 would actually be correlated with low CPI because money is being saved and not being spent. Also would correlate with low GDP growth because money is being generated, profits are being generated, and people are holding onto those profits as opposed to spending them. So M2 rising is usually a leading indicator of future inflation. Well, M2 recalculated is still rising. So we haven't seen the end of inflation yet from that perspective. And most of the reason why inflation has dropped in the recent months is because of everything I've been saying. He agreed with me, this guy, Simon, whatever his name is over Bloomberg. It's because of baseline effects from a pump and dump in commodity prices. But we all know that commodity prices are rising because we've been tracking this here by twice a week for the last 6 months going, yeah, well, commodity prices look like they bottomed. Copper's above $4, the oil is back above 85, blah, 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 blah. Right? Oh, by the way, Zero Hedge runs another article this morning. Crack spreads are widening again for oil refiners, meaning gasoline prices are going to go higher. You think higher gasoline prices aren't going to goose the CPI? I wonder. Or is everybody going to stick their fucking heads in the sand and say, oh no, the inflation's coming, the Fed needs to pivot? Like, it's all dumb. And then there's that article by Joseph Wong about the end of QT and interest rates, and how the Fed has always done QE plus low interest rates and QT plus high interest rates, and that maybe that's part of the problem because that's a way to retard or expand both aspects of the monetary system at the same time. So you have interest rates, and so that interest rates and QT together retard or expand both the financial segment of the economy and the productive sector of the economy, right? So the reserves money, the one affects reserves, the other one affects, the productive economy, the real money supply, the circulating money supply. So, and that they never step on the gas and the brake at the same time. That was that's the general gist of this, and of this argument, and to say that we may be reaching a point where the Fed may want to do exactly that, still engage in QT in order to still engage in QT while they lower interest rates, or continue to raise interest rates and then end QT, depending on which area of the economy they want to stimulate. And since bank reserves, with the they can do that now because they have the RRP facility sitting at $2.5 trillion, which is effectively bank reserves, and they have way too many reserves within the system. We only need, the Fed's own argument is that they only need $3 trillion worth of reserves, and between bank reserves and the reverse repo facility reserves, we have like $5.5 trillion. So there's a whole lot. Again, this is why I keep saying that the Fed has plenty of liquidity available for both sides of the economic balance sheet. They can either stuff the banks full of reserves, or they can stuff the economy full of money, but we don't have to have a recession. And that all the numbers and all the previous predicates and all the previous cycles don't necessarily matter in this environment, because we've never been in this kind of environment with these kinds of tools and these kinds of balances before. The rules are different because the Fed is using different tools to manage the economy than they have in the past. So, big question. So we'll see, right? And so that article, had everybody's brains spinning and asking me about questions about it. So I wanted to address it here this morning. So yeah, like I keep seeing all of it, and to me, it all looks like it's, Fed's got everything under control. I think they can raise 50 basis points, and it won't make a bit of difference. The credit growth or any of this stuff at this point, they can raise interest rates without doing more damage, and continue to do what they've been doing, which is force offshore liquidity into a coma and force the ECB to raise rates faster than they want to. The ECB, Lagarde comes out 2 weeks after she says, like 2 weeks ago or 2.5 weeks ago, she said, we have to stop raising interest rates, right? We got to stop raising interest rates because, we're nearly done. Inflation's nearly tamed. And then she goes to Davos and says, inflation is far worse than we thought it was because it prints at EU inflation prints at 9.2%. Then there's an announcement a couple of days ago saying, we're going to raise interest rates by 50 basis points in February and March. If the ECB is going to raise by 50 basis points in February and March, why is the Fed only going to raise 25? Why would the ECB want to raise by 50 basis points? Knowing full well that they can't afford to have bond yields rise here. And credit spreads are, they're barely hanging on. And we're going to show you this when we get down to the charts in just a minute. They're barely hanging on to current credit spreads. And they've got a euro at $1.09 this morning. That's way too friggin' strong. But I don't know, because I know they're going to try and use the strong euro to go buy. They want to buy cheap oil with a strong euro. That's kind of what they're doing here, right? They want to buy oil before it rises again with a cheap euro in order to refill the coffers for next year or get through this summer. I don't know. I'm not even sure what they're doing at this point, but that's part of what what the calculation is. All right, let's move on to the charts. Look at out of here. All right, so gold. We had the push through the 1915 area buy gold last week on the close. We didn't have a market report on Sunday, but I did at least go over some of the markets in the morning munchings I did the other day. And then we're getting some follow-through action, continue to kind of grind higher. I did this first thing in the morning. We actually pushed back up towards 1930. 33, I think gold's trading at right now. I'm doing this at about 11 o'clock. So that's kind of cool. Just kind of grinding higher. We got an outside bar to the upside. So we broke previous high, didn't break the previous low. We had good pot odds that we would do that. So this is still healthy movement here, even if it's not really moving higher. But again, we're getting towards the end of the month. There's always pressure on gold and silver the closer we get to options on futures expiration and on futures expiration itself. This is just very normal behavior. And for silver especially, because it's a physical delivery month. So, you know, it's tiresome to listen to the people who complain about the slams, and you know, I mean, and these are people who are friends of mine. I mean, they're people in this audience, and they're, you know, friends of mine like Craig Hemke and others, and they can't get past the fact that the markets are rigged. The markets are rigged. Get over it. Move on. Integrate it into your life and stop complaining about it. I know it frustrates you. I know it's wrong. I know it offends your sensibilities, but like, you don't have any power to change it. So, you know, it's like me. It's no different than when my wife looks at me and goes, the guy who's been pissing you off in traffic, he's behind you now. Stop complaining about him. Let him go and move on with your life. Same thing. We have to, as you know, as commentators, really take that into consideration. All of our stress levels would drop, and just integrate it into your thinking. These things don't bother me anymore. I don't get my panties in a bunch or a twist anymore when gold gets slammed on the 830 open. I'm like, I'm actually more interested in when they don't slam gold on the 830 open in New York, going, why didn't they do that today? Yeah, that's weird, right? You know, I'm always looking for discontinuous or anomalous behavior. I'm not looking for behavior that's de rigueur. I'm not interested in that anymore. I'm only interested in behavior that's interesting and different, because that tells you something. That's data. You know, my personal opinion on any of this stuff does not matter. It doesn't, because I can't affect these markets. Well, I mean, you know, I may have an audience, but I can't affect the market, right? All right, so here we are with silver. So everybody was freaking out last week because, you know, silver got crushed into the close and blah 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 blah. We couldn't hold $24, and there was a, you know, wailing and gnashing of teeth, and you know, and there was all of this stuff, and I'm like, dudes, it's the end of the month. What else is new? It's a delivery month. Remember, silver on the COMEX and the LBMA delivered on the odd months. So January, March, May, July, September, and November are physical delivery months for silver. All the even numbered months, February, April, June, August, October, and December, are physical delivery months for gold. That's when they actually do the majority of their delivery, you know, and the contracts that trade on those opposite months are mostly settled in cash. Most all of this is settled in cash anyway. But, you know, as far as how this stuff is actually, the mechanics of how these markets are actually cleared and where metal is moved around and all the rest of it, for silver and gold, they aren't delivered for the most part every month. Okay? Period. And these are mostly not real futures contracts anyway. They don't deliver physical metal. They're not designed for that. It's physical silver more than anything else. So if silver stocks are starting to get low, do you not expect the bullion banks to break the price down in order to try and suppress speculators from taking silver out of inventory, and leave that silver in the warehouse for the producers who actually need it to make keyboards and, you know, circuit boards and all the rest of it? I mean, sometimes it's not even sinister. Sometimes it's just like, look, we have a supply mismatch in the silver market, and we don't need, you know, the Hunt brothers coming in and buying up all the silver supply so that, you know, we can't get, you know, the economy grinds to a halt. So knock the price of silver down and get these guys off their long positions. I mean, it could be just as simple as that. I'm not saying that they're not evil or anything, and they don't manipulate the market. Of course they do. But sometimes, sometimes it's not always monolithic, evil, snidely whiplash, twirling the fucking mustache behavior. It's just not. You know, and as commentators and as investors, we need to know the difference. So when you see a whole lot of offtake on the COMEX for months and months and months in silver, and you see, you know, everybody's out there and the same shills that have been doing this shit for 20 years, and, you know, I've been watching them do this stuff for 20 years. I've been watching this, and nothing ever changes. Like, really? You're still selling newsletters to this? I mean, God almighty, I just want to smack them. Come on, man. Update your frame. Or are you just another, you know? are you the guys that Martin Armstrong complains about all the time? Now, I wish Martin didn't set up straw man when he did this. All he has to really do is just, talk about it. But he'd rather set up straw man arguments and denigrate an entire, class of people, as opposed to just saying, look, you're being gaslit by shills. This is what I'm saying. Don't do it. Okay? Integrate it. Again, it's fine. It's not right, but it happens. So no surprise here. What I'm actually more interested in, the fact that silver's trying to hold up here. And if it ends the month, holding above these lows, that'd be great. If it regains $24 by the end of the month, even that would even be better. But look, we ran up into resistance. Of course, eventually resistance was going to break down the supply of buyers, and the shorts were going to get a hold of the market for a couple of days. And the timing makes sense. And you know something? Abused longs knew it was coming, and so they got out of the way. And then bought here. Like, a whole lot going on in these markets. Especially if you, this is when you dig into the daily charts or the 4-hour charts or whatever, and you can see this stuff happening. But I mean, it's only interesting if you're just, if you want to write a narrative about it, if you want to understand the different players and see the different players in the markets. I used to do this years ago. It's how I learned all this stuff. I used to literally do this for hours on end. Now I just look at it and go, well, that's interesting. Nice. So, oh no. Anyway, Bitcoin, kind of the same thing. All I'm going to say here in Bitcoin, we had a massive breakout, a massive boner bar, and then follow through above previous resistance. We move into this area of the $23,000 range, and so far this week, return to low liquidity or low volatility with an inside bar. Now, for those of you who follow this stuff closely, I will make an update. Normally for these things, I use the last 254 weeks. And not every market is that way, but for the most part, these trading statistics are based on the last 254 weeks on a rolling average. So, it just rolls off so the old data rolls off over time. For Bitcoin, because the prices move so far, so fast over the years, if I were to go back and use the last 254 weeks, we'd be integrating data where Bitcoin traded for $1 or $5 or $10 or whatever. So I don't do that. Well, maybe it's not that old, but you know what I mean. For Bitcoin, I only use data where Bitcoin is trading over $10,000 a coin. That means every once in a while I have to update these statistics, and I try to update them I do try to update them every week or every 2 weeks or so. It was 6 weeks, so I had to add another 6 weeks worth of data, and so these numbers are slightly different. That means that these numbers aggregate now 133 weeks worth of data, because that's how long it's been since Bitcoin passed 10,000 back in 2019. As opposed to 127. That's it. For those of you keeping score and who actually own the spreadsheets and whatnot, for Bitcoin, actually even the Dow Jones, they those numbers have to be adjusted until you get out to 254 weeks worth of aggregated data. In the Dow Jones data, there was a sharp increase in volatility after Donald Trump was elected president, and I noted it on some old market reports, and so I had to adjust my data set then, and I haven't changed that data set since. I still add to it every once in a while. I think we're only aggregating about 190 weeks on the Dow, FYI, and there may be a readjustment in the next couple of weeks, but it's not that big a deal. I just wanted to let everybody know what my process is as much as anything else, because sometimes there will be a sharp jump in these numbers, and you're like, oh, why did that happen? Well, it's because I had to integrate more data. Okay. So that tells you, and the net effect here is that all of these statistics went down in volatility because we had, large numbers of weeks where there wasn't a whole lot of volatility, right? So because we threw off some of the old high volatility data and added some of the new lower volatility data, of course, with these two bars notwithstanding. All right, moving on. Brent crude. Now, we talked about this on the Morning Munchings on Monday. The close on Friday was very strong because it closed above this $87 level here, which is this high, which is the high of this reversal bar, of this non-reversal 3-bar uptrend. This was effectively a consolidation, 6-week consolidation pattern that we're beginning to break out of. Now, I don't think oil is going to be excuse me, completely out of the woods until we get a close above this high, which is around 89 bucks. But it's good to note that we got the final down bar here, no reversal signal here, right? Because we didn't close above the high within 2 bars. Hell, we barely closed above the open. And then a collapse, closing below this low. So this little uptrend here was reversed. And then that reversal signal was then immediately reversed, which is the interesting part about this, meaning that it's confirming that we're not going back down here again. Okay. I'm going to invoke Zorak. We're not going back there. We're not going back there. So that's it. That's the important part here, that oil's probably now looking at a new low, a new bottom in the $83 to $84 range at worst. But what we're getting now is a slight retest of the breakout area above 87. And we're trading at around 86.50 or 87 this morning. And, you know, a close higher this week will mean that we're off to the races, towards moving back towards 100 bucks. So we're going to watch it. There's going to be there's still an epic fight for oil, but basically we have a, you know, this isn't a double bottom because we didn't get back down to here, but it's, you know, kind of a double bottom. It's a bullishly adjusted double bottom, right? Because we didn't get anywhere close to the low. So it looks good. All right, moving on. Patreon request number 1. I might as well do this because I forgot to do those. Okay, so we're going to talk about Verizon first. I got a lot of patron requests to go through this morning. I got 3 slides worth of this stuff, and I'm going to pretty much go over them quickly because I'm already at 36 minutes, and well, there's that. All right, so someone asked me to look at Verizon. Yield is good at what, about 6.5%, trading at about a PDE of about 8.5, if I remember my notes from this morning. I did not go through the balance sheet, so I'm not going to do that for you. This is your homework. Check to make sure that the yield is sustainable, because it's trading like it is not. So check the cash flow statement, check all of that to see how much they're making and how much they're paying out in dividends, and how they're just check for how they're funding their dividends. Because this collapse, we didn't get a 2-bar reversal off of this bottom. And I want to say that that's kind of important. I think the bottom is in here, but this is a weak bounce because there was no reversal signal. And then we get a rally through this high, and they can't sustain it into the end of the year. Now, some tax loss selling, tax loss harvesting, yada, 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 probably. But let's see what happens. It's not a great bottom here. Okay. But, you know, Verizon's a big company. It's paying 6.5%. So a lot of people are going to probably move into it as a safe haven. And I'm going to have to stop talking soon because my voice is starting to go. I think I might have picked up something down in Orlando, and I'm trying to stave it off, but I snored like hell last night, and my voice has been shot all morning. So, okay, let's look at this Pure Cycle Technologies Holding Corporation. This is a very simple, looking at the monthly chart here, this is a very simple consolidation pattern. It's been going on now for what, a little over a year. There was a recent rally, which is probably 2 weeks ago, which is probably why the patron wanted me to look at it to see if it's sustainable. Well, in the larger, this is a classic example of, oh my God, it looks really impressive on the weekly chart, but doesn't look at all impressive on the monthly chart. And this is where you didn't get a breakout through time, and now we're starting to get a pullback, because you can see it right here in the last couple of days. We've gotten a pullback. So that's what you want to look at. Recent rally looks vulnerable, not because it's a bad, I mean, if it holds this level, this 4-bar downtrend within this consolidation zone, looks like a winner, and maybe the beginnings of a setup for breaking out of this range. If you own the stock, you're accumulating on weakness, and you should be selling at $10 until you get a monthly close above $10, or at least a weekly close above $10, or whatever these numbers, these highs are in here. So your homework, whatever these highs, this triple top here is what, $10.50 or something like that, $11, whatever that is, that's where you want to look. That's where you want to set up. And you want to buy the breakout, because then it's going to run to 20. Otherwise, you sit still, because you want to buy. You don't want to buy at 8.5 because it confers no net advantage. It's the true range of it's the middle of the range here. You want to buy below 8.5 or above 10. And you want to buy at 6 or 7, sell 10 until you get the move above 10. You know, I mean that's buying and selling. You take like a portion of your holding and trade like a third of your position if you want to do that. in order to accumulate. And that's an aggressive accumulation strategy. And with a stock like this. So consolidating between 6 and 10, you know, if you want to make it simple, if it collapses further, buy it. If it doesn't collapse, cool, hold your position and wait for a break above 10, and then add to your position on a break above 10, because you'll probably double that money and then sell that money into the strength, and then you're good to go. All right. United States 2-year bond. Someone asked me about whether or not they should pull money out of their out of bonds and go back into a kind of standard stock split, 60%, large caps 20%, smaller caps 20%, European stocks basically. And I would say the thing to look at is whether or not, you know, the bear market in U.S. Treasuries is over. Well, here's the question: the February 1st FOMC is the key. You've got a choppy market in U.S. yields at this point. If the Fed goes 25 basis points, both stocks and bonds are going to rally. Right? You're probably going to move on the 2-year back to about 3.75% or something like that. Because and then stocks will rally because because people are going to believe the Fed's about to pivot and stop raising interest rates or go back to the zero bound. But if they go 50 basis points, bonds are going to sell off here because we didn't get any kind of reversal signal of the uptrend. Okay, because we got this monthly chart here. We got there's no reversal signal here. We didn't close below this low last month. So that's the new floor. That $4 area is about the floor. If we get a 50 basis point raise from the Fed, everything's going to sell off immediately, and then stocks are going to rally. And broadly, stocks are going to rally. The reason broadly, and I mean the Dow, are going to rally because at that point everybody's going to be like, "Oh my God, the Fed's not pivoting, and and then they're going to lose their minds, and everybody's going to move into tangible assets." And I would fully expect the same kind of thing. You'll see a sell-off in gold and then a big rally. So the timing of when you make your shift on your portfolio, I think, is key. Okay. If you're like trying to figure out when you should get out of your short bond position, and should you go long stocks? All these markets are chopping at this point because there's a lot of confusion, because there's a lot of old illusions and old ideas that need to die hard. This is all the stuff we talked about in this month's newsletter. And so it's a very difficult time to try and figure out what to do. And, when the market's not giving you a clear signal, what's my usual advice to you? Don't do anything. Don't buy, don't sell. Stay in cash and wait until you get a clear signal, and then make a directional bet. That's generally the way I look at it. All right, Patreon request number 2. I'll put everything up on the board. Ignore this down here at the bottom. First, I want to look at the NASDAQ and then the ETF, the ultra pro short NASDAQ ETF, similar to the ultra short Euro ETF that we have. What's important here is to look at the monthly chart of the NASDAQ. Now I have the weekly chart of this in place because the monthly chart of this is useless. What you have here is a collapse in the NASDAQ. Here's your down bar here. Then next 2 bars, we get a bottom. Like there's a strong bottom here in the 10,000, 10.5 or 10.5 area, 10.2 to 10.5. But there's no reversal of this bar. And then look at that bar. No reversal of that bar either. So we've got a bottom pattern forming here on the NASDAQ, but no strength. Now, this bottom pattern can persist for a long time. And if it does, the value of this ultra short ETF is going to get crushed. Okay. It's because of the way way the math works out. Okay. Hard to make money in these unless you're playing the options market. So this breakdown here, after right here, that's right there. And that's actually this. It should be there at the bottom there, right? Because this is the short. I'd watch this. Like, I don't know that you're going to get a rally in the NASDAQ. So it's possible that this is setting up a nice double bottom here for you to make some money coming off the 40 and go into 60. Because the NASDAQ could collapse through 10,000 and go back to 8,000 or even 8,000, 9,000, 8,000, possibly even a low towards 7,500. Because tech is out of favor right now, right? But at the same time, everybody's cutting jobs, and you know how much the stock market likes it when they cut jobs. And well, they should, because it's a burden off the balance sheet. Now, by contrast, I just want to show you the difference between the indexes, because now we have, by contrast, we have the S&P 500, which bottomed around the same time as the NASDAQ. But notice how we got a much stronger bounce, even though we didn't get a reversal here because we didn't close above that high. We still have, you know, look at the lows. We're getting a nice wedge pattern here. This is a firmer bottom. Okay. And so no reversal there, but then no reversal of this of the bounce to negate the bounce. As a matter of fact, we still haven't violated any of the lows. Whereas on the NASDAQ, we're violating lows. We're doing all sorts of horrible stuff. So this is a much stronger bounce. And yet we're telling you that we're getting the same strong chart pattern here. Me, I would not be short the S&P 500 with this monthly pattern. I could see going short the NASDAQ with this monthly pattern. And I would probably do this with if I were trading this, I would probably do this with a low money commitment options bet. That's the way I would do it. And I'm not going to get into, I'm not an options strategist, so, but I would make a directional bet, put a couple $100 on the table and see if I hit a 4-bagger, basically. Okay. That's the way I would trade it. So just to note the same relative performance for two completely different bottoming patterns. This is some of the problems of these leveraged short and leveraged long ETFs. In the end, the market makers are the only ones who make money on these, especially in stocks and in volatility. Like, everybody likes to play UVXY, and I'm like, which is the 3x ultra short VIX. I'm like, it's just that is literally like playing craps, and I don't like those odds. The currency short ETFs are more like playing roulette, and you're playing much thinner odds. You're still against the odds are still somewhat against you, but if you're playing roulette smartly, like you're only burning 1%. The house has only got like a 1% advantage on you. 50% of the time, the house 50.5 versus 49.5. This is what the odds are. Craps, I think, is the worst of the bunch. So that kind of thing. All right. Next, last thing to talk about here. I got two stocks for you. Is someone asked about the Turkey ETF. I went into the weekly chart, not the monthly chart, just to show this. This is probably why everybody freaked out, or why the patron freaked out a couple of weeks ago. Good call. It is something to worry about, but note the pattern. We get a big move up, a big move down. Big move down. This is a reversal bar, but then we open high and we get another reversal bar. So there's a whole lot of volatility happening in the Turkey ETF here. What I would suggest is this: if you're in the Turkish ETF, and you've made money in it, you've made good money in it, I would pull at least half your position off the table. That's just a standard thing. You've made good money in it. At least pull your initial stake off the table and let the profit rise. And then you'll know when you want to start, because the monthly chart will tell you if there's any real problem here. And the monthly chart really doesn't say anything. I wanted to drill in here to the weekly chart to show you what I'm talking about. The monthly chart looks good for the most part. It just looks volatile here. And maybe this is the sign of we're done, right? Because once you start getting into crazy volatility like this, it's usually a sign that the bull market is about done. So it's at that point you just want to get out of the position. And then over here we have Freyr Battery, and all I want to note here is that, wow, this was nice. Again, monthly chart. This was nice. This was nice. And then, like with all small caps, then the news cycle started hitting. And all I'm going to say is, look, I never like bullhorns, right? I'm not a big fan of drawing lines on charts or anything, but I'm going to tell you this: when you see higher highs like that and lower lows, and you can't draw any parallel lines, you don't have any trend action. I don't know anything about this company. I just know that I wouldn't want to be anywhere near this stock unless I was day trading it and digging in on a daily basis. And then there's some good money to be made if you can ride out the whipsaws. And I know that I'm not that good. So I wouldn't even play it. But if you like the company for whatever reason, I don't know what's going on here. But clearly there's an epic fight for what's, and there's an epic kind of, this has like all the hallmarks of a boiler room screwing with the company at this point. And I'd stay away. But I'm really conservative. So there you go. All right, let's get to the overseas dollar markets. I'll get you out of here. So I want you to, so after this note about volatility, which is why I brought this up, I want you to note the volatility here. We have a continual violation to the downside and continual violations to the upside. Now, this is a bullhorn pattern on the U.S. German 10-year spread. That's not a good sign for Christine Lagarde. You'd want to see no violations of the lows here. You'd want to see an upwardly sloping thing like you saw. Like this is a nicely managed uptrend here. This was a nicely managed uptrend here. You can draw some nice parallel lines and you can connect some bottoms and connect some tops. And for the most part, these are well-ordered waves within this thing. And then you get into this crap here. And yeah, this is a bullhorn and presaging the collapse. This was also after the Bank of England was, this is during the Bank of England spasm and then Credit Suisse. And now we're into the new year. And Lagarde is clearly losing control of the credit spreads between U.S. and German debt. Clearly, she's losing control and trying desperately to hold on to it because she keeps pushing it up on days when the U.S. markets are closed. Like this 1.42%, 45% happened on Martin Luther King Jr. Day when New York was closed and Frankfurt was open. Of course. So SOFR versus 1-month LIBOR is telling us next week we're going 25 basis points. We'll see if it happens. And in doing this, what have I been saying? In doing this, she can't protect credit spreads, so the euro keeps rising. So she clearly wants a higher euro for whatever reason, and she's losing control of the markets. Also, note U.S.-Italian 10-year spread bumped out over the course of the last week from 34 basis points back out to 62. The euro-dollar inversion is definitely set around the June area. They still think that in June the Fed's going to pivot. Okay, and just over 5% no less. Okay. Again, are these markets mispriced? I don't know. The yen is stable between 120 and 130. The yen, the yuan has moved back. Onshore yuan has moved back into the, is starting to break higher again after dropping down to as low as 6.7. The ruble is off a little bit. Doesn't really matter. And then copper is holding $4.23 a pound, with oil at $88 a barrel, or $87 a barrel. Gold at $19.30. Yeah, the inflation trade is over. Yeah, really? Okay. Last thing to talk about. No, we're out of here. So the Dow. So I showed you the S&P 500. I showed you the NASDAQ. And then note the Dow. Now we had a 1-bar reversal here on the Dow. We closed below this low here. Here's your uptrend. Right. This is but again, this isn't a strong uptrend, right? Because we had, so big uptrend here, 1-bar reversal, reversing this uptrend, because here's the last up bar in the trend. We closed below the low. That's a 1-bar reversal. No big deal. It's even a well-mannered 1-bar reversal because it's even an outside bar and not an engulfing bar. Then we get this crazy thing centered around probably the FOMC meeting from December, where, again, the market was mispriced and the Fed won 50 basis points. And everybody was like, we thought you were going to go 25. Sound familiar? And then crazy volatility. But ultimately, for the week, we ended down, right? So nice, strong 2-bar downtrend. Open low, open here, violate the low, start building a new base around 32.5, 32.8, but there's no rally. And and in order to negate these 2 bars, you got to break this high. Now, even if you think that this high is like nonsense, even if you just want to break this close here, just to be really aggressive in your accounting of what you think is or is not a reversal signal. Took 3 weeks to get there. What do we always say about 3-bar reversals? They're not really reversals because they confer no net advantage, because 50% of the time they continue up and 50% of the time they collapse, be it bullish or bearish. It doesn't really matter. In this case, it's the bullish one. And then what happened? We went up, got into the range of resistance, bing, 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 boom. And then we get a 1-bar reversal of this weak uptrend immediately, and then we throw a low volatility so far through 2.5 days of trading, a low volatility inside bar. So is this reversal signal strong? I don't think so. Did it violate? Did we see any low violations here? Not really. So I don't know. It looks to me like the market doesn't know what to do. But in comparison to the NASDAQ and the Dow, and the NASDAQ and the S&P 500, Dow looks positively great. And that's the important part. International capital moves into the Dow because it's the deepest and most liquid. And that's what you're seeing. All right. And ultimately, that's what we have to respect. And last week was a high volatility week because this sums to 58% as opposed to 100, which would be normal volatility. And so we have a high probability this week of throwing an inside bar. I love the fact that it's this low. The volatility here is this low, though, because that's telling you that this is maybe overdone. We'll see. All right. That's what I got for you this morning. You guys be well. You take care. We'll talk soon. We'll talk on Sunday. Keep your stick on the ice.